Well, it was something of a rollercoaster ride for financial markets last week, with an initial bout of risk aversion and carry trade unwinding fading as the week progressed, allowing stocks to end the week pretty much exactly where they started. Although, of course, volatility does remain elevated across the board, including in the rates and foreign exchange markets. Another busy week now lies ahead for market participants, with US CPI and retail sales the obvious highlights. But a busy UK data docket also lies ahead, while we also await policy decisions from New Zealand and Norway. Plenty to discuss on the trade-off this week. Without further ado, let's get into the show. So, as you can imagine, plenty for us to discuss on the show this week. Without further ado, let's bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, you asked me when we jumped on to start recording a moment ago, was it a blessing or was it a curse that we didn't record a show given the volatility last week? I don't know about you, but I'm coming down firmly in the blessing camp because there was enough going on as it was last week.
Yeah, exactly. I don't know how we would have got through all that like yesterday, last week. Particularly after that Monday, which was absolute carnage and my first day back from holiday. So I didn't have a clue what was going on. So good that we skipped last week. We can concentrate on this one.
Indeed. I mean, some uncharitable people would say no change there, but I'm not going to be that unkind. You certainly were thrown in at the deep end when you came back. But just to touch on that, I do think it's interesting how, you look at the S&P and we ended Friday marginally higher than where we started the week. And the same can be true, can be said, I should say, for most other assets. I think it's just interesting the degree to which markets, apparently overreacted to what was a softish payrolls number and a marginally more hawkish Bank of Japan, which I guess speaks volumes about sentiment.
Yeah, it brought all the market bears out the woodwork, didn't it? They've all been in hibernation. This was a chance to push things their way. But you've also got to remember this is the state of markets now. We've got a lot of electronic trading going on, a lot of robots going, and they don't have that human touch. If they get orders to sell, they just keep selling until they're done, and it doesn't matter what's in the way. Whereas if it was humans trading, they'd take a bit more of a calmer approach if they've got so much to do, rather than just sell it into the hole, basically. But as part and parcel of the markets, we're here to trade them and pick up the pieces afterwards.
Indeed, yes. And whether you think it's right or wrong, I think things have sort of irrevocably changed in that direction. But I know you want to get onto that in a moment. So why don't we get on to Topical Thunder and crack on with the show? Like I said, Ryan, I know you want to discuss that in a bit more detail in a second. But before we do, I just wanted to discuss some of the US data releases that we've got coming out this week, because it is a big week of data stateside. We've got the latest CPI figures and, of course, retail sales, the main event. Although we do have a few other bits and bobs going on as well. The weekly jobless claims data, PPI, industrial production in the mix as well. Now, personally, I would argue that actually retail sales is of much more importance to the financial markets this week. And the reason I would argue that is because one of the big driving forces of price action over the last week or so, since that non-farm payrolls number on the 2nd of August, is this narrative about a US growth scare that seems to have taken hold. And also, I'd argue that we know the Fed are going to cut in September anyway, and that it's probably going to be a 25 basis point move to start with, no matter what the CPI number says this week. In any case, headline CPI is expected to have held steady at 3% on an annual basis in July, while core CPI is expected to come 0.1% lower to 3.2%, with both of those metrics likely giving policymakers further confidence that the US economy is indeed continuing on that disinflationary path. One thing I would say is that in a change from normal programming, the PPI, the producer price index, that is actually released before CPI this month. So we get PPI on Tuesday and then we get CPI on Wednesday. So perhaps we could get a little bit of positioning post PPI as participants use that as a leading indicator for what we may get in the CPI figures on Wednesday. As I said, though, retail sales is the main event for me. We're expecting sales to have risen by 0.4% on the month in July, having remained unchanged on a month-on-month basis in June. Of course, the control group sales measure is really the focus, as that is the basket that feeds directly into the GDP calculation, and that is expected to rise just 0.1% on the month after a pretty chunky 0.9% month-on-month rise in June. I think the market playbook here is pretty simple. If we get a better than expected retail sales print, you would expect risk to rally, perhaps the dollar to rally as well, given that it's been trading in line with Fed policy expectations of late, and the market then would have the green light really to just go for it into Jackson Hole at the tail end of next week. On the flip side, if we see a miss, then you would expect those growth jitters to make something of a resurgence. Nevertheless, if you look at the OIS curve at the moment, we've got about 35 basis points worth of cuts priced for September, about 95 basis points worth of cuts priced by year end. And I don't know about you, Ryan, but both of those look far, far too dovish for my liking.
Yeah, very much. Have we finished pricing the inter-meeting cuts that pricing the other week?
I think that lasted about 10 seconds, didn't it? And rightly so.
Oh, crazy times. But yeah, I think things have calmed down there. Like you say, OIS numbers, 35 pips. Yeah, okay, it's a bit over a 25 pip cut, but it's there or thereabouts. CME Fed Watch is one I keep an eye on. We were pricing 80% chance of a 50 pip cut in the September meeting. That's down to now 51% chance of going 25 pips. So that's come back down to normality. I'm waiting as usual for all the bank calls that are still screaming for 50 pips at the set meeting to go into reverse.
Where'd your paperwork go on? I had visions of you waving bits of paper around and all sorts here.
I printed off. There was a graphic someone put up with all the banks and their calls for September and for the rest of the year, and I've got that on my wall ready to, as you say, wave it in the air when it goes up in flames. We've had the crazies
on your wall, but
obviously not one that's on my wall. We've had the crazies. That Jeremy Siegel, who said the Fed should cut immediately, 75 basis points. You know, he went into reverse. So craziness aside, exactly. Craziness aside, things are back to a bit more of normality. But as you say, 35 pips is still over what's expected for September. So I think this data is going to jiggle around those rate expectations very much. So CPI. Yes, retail sales are probably going to be the more important factor after the NFP, but that CPI, if we start seeing a two-handle on both the headline CPI and the core, that's just going to firm up rate cut expectations, and probably more so for the future and for the dots as to how many more cuts we might get into the end of the year. I'm probably alongside the two cuts, depending on what the data tells us. It may only be one, at the very maximum three, if we really see an inflation dropping down and the economy falling off a cliff. But other than that, I think we get the cut in September. This data will either cement that or take away a little bit from that. And then we move on to Jackson's Hole next week and hear what Powell has to say.
Indeed, we do. I agree with that. I'm still in the two-cut camp. I think September and December, 25 bips apiece. If the economy rolls over a bit more significantly, which it doesn't look like doing so at the moment, then maybe you add another 25 bips in November. But I don't think the Fed are going to want to overreact too much to any single data points. And I think 50 basis point moves are certainly off the table for now. In any case, Ryan, I know you wanted to dig into last week a little bit more, because I imagine you sat down at your desk on Monday morning, fired up your trading terminal and thought, what the bloody hell's going on here?
Yeah, as I was saying before we start the show, I didn't even look at the screen Sunday night when I got back. I just switched on Monday morning and sat down, nearly got up and walked out again. So just seeing the blood on the screen, shall we say. So, I want to talk a bit about that. And, when you see markets with that sort of volatility, there's a couple of lessons, a lesson I want to give. About following the volatility and what you need to do about it. It's to make sure you don't get caught up in all the drama. If we take one aspect of last week, it was some areas, as we said, getting far too excited about Fed cuts. As you say, people going on about inter-meeting cuts and 75 pip cuts and all the likes like that. And we were even pricing that, as said, at one point. Now, several of the banks did change their call to 50 pips, while others added extra cuts for the year. Once again, we saw that extreme move in the pricing that didn't really reflect the fundamentals. And that's the important point here. That's lesson one. When the market starts running too far one way, you have to match it off against what you know of the fundamentals and what you know of the central bank or banks itself. If there's a big disparity between the two, there's your trading opportunity, because you can look at maybe fading some of those moves. Lesson 2 is when you do get big volatile moves like last week, a lot of those moves are hard to trade, even if you know them to be wrong, because volatility is the killer. And, you can have the right trade, but the market can still stop you out just on the volatility before it goes your way. So the only real way to trade it is to switch to the higher time frames and look for the big levels to trade, like the multi-year levels, for example. If you look at dollar yen as one example, over the last 2 or 3 years, even if at its most volatile moments, it's respected the big levels. And those are the levels you want to identify during periods of high volatility, as they can often win out against that volatility. The last lesson really is, if you don't know what to do, sit it out, let the dust and volatility settle so you can get back to trading things your own way. In trading, it's a lot like football. There's times you want to attack and there's times you need to defend. And for me, sitting down and seeing those moves last week was definitely a time I wanted to defend and protect my account.
Where are those yellow cards that you brought the other week? I feel like I need to give you one now for that football pun. In all seriousness, though, you do make a very, very good point. I would agree with everything you just said. That's certainly one of the reasons why I like to certainly stick to taking more of a longer term view and trying to ignore the intraday noise, the volume of which only grows louder when we have a situation like we did towards the start of last week. And absolutely, I think the first thing for any trader to remember, not only when markets are jumping around all over the place, but even when things are quiet, is that priority number one is capital preservation. It is living to fight another day, so to speak, in the financial markets. And there is absolutely nothing wrong with stepping away from the desk and not taking a trade in that sort of an environment. If it doesn't suit your style, if it doesn't suit your risk appetite, whatever it may be, if you're not comfortable trading, then do not trade in that sort of an environment. And actually your account will thank you for it in the long term, because yes, you may look back and go, oh, I wish I bought, the S&P at the bottom, or I wish I shorted Bitcoin at the top, or whatever it may be. There are plenty more opportunities that are going to come along. That is simply how the market works. And if things are not suited to your trading style at any one time, step away and come back.
Yeah.
We'll be able to fight that other day if you do so.
Yeah, volatility is a double-edged sword. You can see big price moves and think, oh, I want to capture some of that, but that can also impact your trading account if you don't pick the right levels, and it moves 100 pips, 200 pips quickly against you. So it's big rewards, but also bigger losses.
Absolutely. Right, let's move on, because we've got a busy week of UK data coming up. It's busy in the United States. It's even busier here in the UK. Question number 1, Ryan, are you going to be up at 7 o'clock every morning at your desk for this data to come out?
No.
Of course he's not. On that note,
I'll be up for the CPI probably, and I don't know. So some holidays I'm allowed to lay in for 6 weeks rather than getting up at 6:30, 6 o'clock in the morning to get the kids out of bed. But
I was going to say, well, are you a schoolboy or something now, having 6 weeks off in the summer? What's going on there? But there was actually, on that note, an interesting paper that the BOE, of all people, published last week, talking about liquidity in the short-term interest rate market in the UK. I appreciate that sounds incredibly boring, but the point of it was that you end up with much more volatile and choppy price action with data being released at 7 a.m. because obviously STIRS opens at 7:30 and everyone reacts to that data bang on the market open, than you do when the data used to be released at 9:30. The market functioned a lot better and a lot more smoothly. So of course, if the ONS are watching, then 9:30, please go back to it. Anyway, the data that we do have coming out this week, Tuesday, we have the latest jobs data. Of course, that will be out probably by the time you watch this show. The usual caveats with the ONS being incredibly unreliable, particularly when it comes to the unemployment rate, do remain. Although we are expecting average hourly earnings to fall quite considerably to 4.6%. on an annual basis, down from a prior 5.7%. A big chunk of that fall coming from the public sector, particularly NHS pay rises that came through last June. They have not been repeated to quite the same degree this time around, which should depress earnings growth a little bit and move it to a level that is increasingly consistent with the 2% inflation target. Speaking of inflation, we obviously get the latest CPI figures on Wednesday. Headline CPI expected to move higher, actually, to 2.3 from a prior 2%, so back above the BOE's target after 2 months at that level. Although this is pretty much all due to energy prices. They fell around about 7% in July, although there was an even bigger fall in energy prices last July, which means that the base effect is going to push headline inflation higher. Core inflation, though, expected to come lower a tick to 3.4%. Services inflation expected to come lower by a couple of ticks to 5.5%. We may even see some of the unwinding of the impact of Taylor Swift's concerts in the UK in June beginning to move that data a little bit lower. That is true, actually, because the ONS used such a limited sample size for hotels. Hotels bumped their prices up in the month, and it skewed the services inflation figure higher because Taylor Swift was here. It's a global phenomenon. You can go and
do we need a new metric at the ONS for inflation, the Taylor Swift index now or something?
I think we do. I think that's certainly where they're going to be going in the very near future. Sticking with the ONS, Thursday we get the latest GDP figures. The economy expected to have grown by 0.6% on a quarterly basis in the 3 months to June. That's compared to a 0.7% pace that we saw in the first quarter of this year, another pretty solid pace of expansion, and as near as makes no difference, in line with the BOE's latest economic forecasts. And of course, the week wraps up on Friday with the latest retail sales report. Sales expected to have risen by 0.6% on the month in June. It is a very, very volatile data series. Of course, you do have the positive influence of the Euro 2024 football. That may have boosted sales somewhat, but also remember July was incredibly wet, which could have posed a bit of a headwind to spending. So God knows where that retail sales number is going to fall on Friday. The pound comes into the week on the back of a 4-week losing run, which is cable's worst in a few months. The OAS curve fully prices the next BOE cut by November, with about 45 basis points of cuts in the curve by year end even, and of course the jobs, but even more so the inflation figures hold the key as to how both of those evolve over the next 4 or 5 trading days.
I'm still in shock that we've managed to drop Taylor Swift into this financial conversation. So
the thing is, there was a blank space, so I just had to say it.
Well, just make sure you tag her in when we release this video on Twitter. Maybe we'll get some extra likes on.
I will. It's just the thing is, these videos are just like a love story between you and me, aren't they?
Exactly. Oh, God.
I've run out of song titles now.
Oh, yeah, that's the only one you know, isn't it? That's it. And you've probably got all her albums as well.
Anyway, yeah, naturally.
You Swifty, yeah. I'm going to call you that from now on, the Swifty. Right, so let's get back to talking about.
It's all falling apart.
It's all gone horribly wrong. Inflation. This is one of those weird times where, inflation is expected to go up, and rather than trying to guess when the BOE next going to cut, this inflation is going to be talking about maybe when they're going to stay on hold, because if it does go higher, then obviously that's going to push out the timeline for a future cut. So we've really gone from watching CPI coming down to watching if it starts going up again. Still around that 2% handle. We're bang on target. If it does tick up, we've had BOE's man going on about sort of effects that might be happening next year, because some firms and people have been sort of not increasing prices as much as others were, so they need to do a bit of catch up. You talk about wage rises. Well, we know the NHS have got another bumper pay packet coming as well. All those junior doctors getting their increase as well. So there's still some pressure to feed in from there. So we're not quite out the woods with all that. And as we get into winter, we obviously know that fuel prices are going to rise, so we're going to get some more inflationary pressure coming in there. Retail sales, I don't know. It's shut your eyes and pin the tail on the donkey for what happens with those numbers at the moment, when they come in, come down.
Like our non-farm payrolls, yes.
It's exactly that. So they could come in anywhere. And as for the jobs, again, they could be bumping up again later in the year or into the next financial year. So, yeah, the market's going to be sitting there wondering when BOE is going to cut next. They don't know. We don't know. Nobody knows. So let's just trade what the data does, and we'll look at some of the levels later, I assume.
Yes, I can't remember whether I put a cable chart in, but we might do. If not, we'll have a look in the
We'll
next
make it up.
Indeed. Right. Moving on, central banks. If you want to start about puns, what on earth is your caption for this?
Oh, well, I didn't know if it was going to fit all in. I was going to do a Kiwi, a wallaby, and a polar bear walk into a bar, but I don't think it fits across the screen, so I just stopped there. But what we're talking about three other central banks. Oh dear, we need to start this again, I think. But yeah, we've got two more central banks on the cards and some data for a third. We've got the RBNZ. Their meetings on Wednesday, their announcement on Wednesday, expected to come in unchanged on their rates at 5.5%, although the decision could be a bit more of a surprise, as we've got economists and analysts expecting them to stay unchanged, but the market pricing is showing some 70 to 80% chance of a cut, 75, 80% chance of a cut. So it's a bit in the balance, this one. If you just want to take inflation alone, core CPI in their last numbers came in at 2.8% in Q2. That was down from 3.7%, so quite a significant fall. And one of their preferred CPI numbers, one of these central banks that like to have 18 different ways to count CPI, that came in at 3.6% from 4.2%. So they've got one sticky one and one pretty much within their target. They run a 1 to 3% target range. Now, as mentioned, with one of the highest interest rates among sort of the major CBs, the case for a cut may be towards the market pricing. So I think maybe a cut could be on the cards here. Just, again, one of these little start-us-off cuts, shall we call it. Now, after the RBA last week, Thursday, we've got jobs data from Australia. It's the market's first chance to start measuring the data again ahead of the next RBA meeting. Jobs are set to increase by just over 20,000 versus a 50,000 gain last month, while the unemployment rate is set to stay unchanged at 4.1%. So really, just take your cues from whether we have a big variation either side of that. On Thursday, we've got the Norges Bank, and again, an unchanged decision is expected. And again, just purely taking the inflation numbers to hand, CPI moved up in July to 2.8% from 2.6%, while the core just came down a pip to 3.3%. So inflation there still very sticky. The bank themselves are forecasting rates to stay unchanged until year end. So there's really been nothing in any of the data to say they'll change that view. But you never know. They might lob something into the statement that just changes the picture slightly. So two more central banks to watch and a bit of data for a third.
Indeed, yes, plenty going on this week. I think the RBNZ is undoubtedly the more interesting of those central bank decisions, given the it's almost similar to the BOE decision actually a couple of weeks ago, where you've got the market leaning strongly into one side of the equation and the sell side leaning strongly into the other. Of course, if you are trading the Kiwi dollar, then naturally watch your exposures over that decision. The RBA don't seem particularly inclined to do anything at this moment in time, so I don't think that the jobs data is going to move the needle significantly there. They certainly don't look inclined to deliver another rate hike as some have been expecting, but I think they're also quite likely to be one of the last to actually deliver a rate cut. That's probably towards the back end of the year at the absolute earliest. And then of course the Norges Bank, as you said, their inflation is moving in the wrong direction. And they've said they're going to remain on hold, and you would expect them to do so. Although, of course, some attention will be paid to any revisions to that rate path. But an interesting one. And of course, that sort of eases us into Jackson Hole towards the back end of next week, when the great and the good of the policy world will be descending on Wyoming to, chat nonsense, basically, and drink beer and go fishing, presumably.
Yeah, shoot some deer or whatever they get up to. Yeah, they take a break from their holidays to take another holiday in the US. It's a hard life being a central banker these days.
Indeed, it's all right for some, isn't it? Right, let's move on to some charts in That's a Setup. Okay, so I want to start off with the dollar this week. The greenback has been consolidating, really, around the 103 figure. We did have that brief foray down towards 102, the handle on Monday last week as part of that broad risk aversion. But the dollar has recovered some ground since, as the market has paired some of that extreme dovish repricing we saw. I think Ryan alluded earlier to the possibility of even an intermeeting cut that markets were discounting at some point last week. And of course, you've also seen the dollar recover ground as the front end of the Treasury curve has sold off as well, and yields have risen actually across the curve. Of course, that begs the question of what comes next. And I'm still in the camp, actually, that it's relatively tough to imagine a prolonged dollar downtrend unless we see growth really begin to equalize between the United States and the rest of the world. And frankly, that seems a bit of a long shot at the moment, particularly when you look at developed economies like the Eurozone, like Japan, where things are still struggling quite significantly. And of course, you've also got around about 100 basis points worth of cuts in the OIS curve, and about half of that is probably going to have to be priced out, given what Ryan and I were saying earlier, and also the likelihood that the Fed want to ease and normalize policy at a relatively cautious pace, at least to begin with. The bulls' first target is likely to be a retest of that 104 figure. Although, of course, we have the 200-day moving average lurking just above around 104.20. And I think last week's lows, even if I could say it, just north of the 102 figure should be the limit of any downside for now. And if we were to get there, then I think the dollar would be looking like a buy on dips for me. Brian?
Yeah, that chart that you're showing there, it's very similar in a lot of pairs. You know, we've had obviously this big move down, and we've had a retrace back. I don't think anything is out the woods yet. You know, if you look at that wider picture, we are in a downtrend in the dollar. I don't think that's going to change. The market has been chasing cuts all year. The market's going to be reacting, as we've seen, more to bad data than it will react to good data. So I think that the downtrend is set to continue. It's obviously not going to go in a straight line, a bit like the data itself, that we're not going to, this soft landing is going to be bumpy. It's not going to be a straight line. So I think for now, rally selling in the dollar is the way to go forward. Pick your levels. I think you've got to be very, very choosy. Anything up towards that 104, 103.80, that sort of area is going to be choice for the sellers to come out if you happen to trade these futures rather than the basket currencies themselves. So, yeah, I don't think we're done with the downside. But if we start to break above, if the data doesn't turn and starts ticking up again and we get solid job numbers, solid retail sales, then that's obviously going to keep the Fed in tightening mode, and that's when you see a real recovery in the dollar. And you've got to remember, you know, we could get a retail sales data in the US, retail sales data in the Eurozone. It's going to be the US that really moves the market more than the Eurozone one does. So it's always the fact that dollar data or US data is going to move markets more, and the same with rate expectations.
Yes, absolutely. Right, a little bit of a policy divergence trade coming up, I feel.
Yeah, we were talking about the RBNZ they're announcing, and obviously we had the RBA last week. So with this data and with the RBNZ this week, it's getting closer to crunch time for some of these banks who have yet to start on their cut cycles. And until they do, the market is going to continue to play the guess the cut time game. Now, following the RBA's hold last week, it's the RBNZ's turn, as mentioned. The decision could go either way. For this pair, Aussie Kiwi, it's been looking fairly bullish while the RBA sort of keeps its hawkish undertones. It rallied from the 108 magnet late in June all the way up to 111.50. But what took sort of a month and a half to go up has taken less than 2 weeks to go the other way. Some of this reverse has been down to softer commodities like copper, and also the moves in the yen, of which Aussie yen has been one that got hit hard. So if the RBNZ do surprise with a cut, we're likely to see a pop higher again in this pair. And I'll be looking back towards that 111 area for a possible short. This was actually a trade I did try in that June run-up. I was shorting it from the 110s up to the 111s. Unfortunately, I had my stop a bit too tight at 111.30, so I managed to fluff that trade. But what the price action has confirmed is that the range is still valid to trade either side of this big 108 level, which the price has reverted back to time and time again. So for now, I'm going to stick to trying to trade the edges of this one and letting it do its thing in the middle.
Good stuff. That's another theme actually that we've started to see in quite a few pairs and actually in quite a few assets more broadly, where you've had these trends that have been in place for quite some time, and then in the space of a week or so, they've evaporated. Very much a kind of stairs up, elevator down approach, to coin a famous adage. The Aussie Kiwi cross is always one I've looked at in a bit of a similar way to Euro Sterling, because they just don't seem to do a lot. They spend a lot of time going not particularly far. You wonder whether this is just another case of, as you can see on that chart there, the cross moving back into this kind of 105, 106 to 110 range that we've been in for much of the last year or two.
And that's the good thing with trading pairs like this, where they are a bit slower, the levels tend to get respected a bit more. You may have to wait a longer time to see them, to actually trade them. But when they do, as I said, I messed this one up. And if I'd had a stop 20, 30 pips higher, I would have had a good trade. But we can't trade backwards. But it just shows you how these levels interact time and time again. There's not 100 different levels on that chart. There's 5 or 6. And that's all you need to trade.
Indeed, I fully agree. Right, moving on, speaking of levels and speaking of technical trends, gold has become something of a technical analyst's dream. That's easy for me to say,
right.
Even if price action has become... Sorry?
I was saying, better make sure you get that one right.
Oh, yeah, exactly. That could have gone horribly wrong. Right, let's get away from that very quickly indeed. If you look at the price action in gold, it has become a little bit boring, although I would argue that some of those slower moves perhaps are suggestive of a more sustainable rally than we have seen previously over the course of the year. We do, of course, continue to respect the 50-day moving average to the downside, as we have done since the start of July, testing that level on 3 or 4 occasions now, with price bouncing off on any downside tests, while of course the 100-day moving average lurks just below as well. And we also have clear resistance. We've got a few of the prior highs here, and then of course we've got the double top around $2,480, $2,485 an ounce. That's from early July and early August, which is of course the key level for the bulls to watch. And I think this is relatively simple from a technical point of view. You're buying dips in towards the 50-day moving average and targeting that double top to the upside. Although I would just caution that obviously over the last week or so, we have seen a sell-off across the Treasury curve, with yields higher across that curve, and the stronger US dollar coming through as well. And of course, that is perhaps going to pose something of a headwind despite these relatively strong technical signals that the market seems to be sending.
Yeah, I think you've got to be aware of what's driving gold at the moment. We know that China, for the 3rd month running, haven't been in the market buying gold. They were one of the reasons why we saw the big rally itself up through 2000 and up to the levels we're at now. So they've paused their buying, but we're still up here. This morning, it feels like maybe this is more of a risk trade with everything that's going on with Russia, Ukraine, and Israel and Iran. So I'd be a bit cautious about trusting more the fundamentals rather than the risk picture. If there's a big headline, a negative headline, this will blast through those highs just purely on the back of risk. So it's one of these times where you follow the text, but just be a bit cautious about trading them, depending on what's driving us to level. You saw me just looking right a moment ago. We're trading at 24.50 level right at the moment. So yeah, keep this one in your mind, trade the levels, but show a bit of caution given why we're moving at the moment.
Yes, indeed. I fully agree with that. And of course, the other thing to bear in mind is anytime we see market, I don't want to say turmoil, tumult, like we saw on Monday last week and towards the start of last week, cross-asset correlations effectively go to 1. And what I mean by that is basically everything moves in the same direction in a very similar magnitude. And I think that's obviously something worth bearing in mind as well. Right, last but by no means least, we're going to have a look at the yen.
Yeah, going to look at dollar yen. This setup section is more an example of what I mentioned in my earlier topic about listening to your charts in volatile times. So last week I sat down, as I said, after my week off on holiday, to the carnage unfolding. And so I wasn't in the best place to start jumping into trades. So rather than start gambling on levels amid the high volatility, I switched from my sort of what I call my everyday charts to my wider picture charts. And that allowed me to pick the places where I deemed it potentially safer to trade. Now, the area identified in dollar yen to try and maybe fade the drop that we were seeing was down at the white 61.8 fib of the 2023 swing up and the yellow fib 38.2 of the 2021 low. Now, what I liked about the 139, 140 area was not just the fib levels, which do work very well in this pair, but that they had been levels all on their own before these fibs even existed. If you see the three green circles, you can see how the price respected those levels 3 times before we even got to being able to draw these fibs on. Now, to emphasize why I like these longer term fibs, if you just look at the blue one, which I've kept on my chart, even though it's sort of a bit defunct now, that was the fib that we made from the 2021 low to the 152 high. We pulled back to the 38.2 before bouncing, then dropped to exactly the 50 fib level, which held and was actually the springboard to the highs up at the 162s. So that just shows you how these fibs work well in this pair. When you see something that pulls back, you've got to take it as a sign. Is it the trend reversing, or is it just a pullback and we're going to kick on further? Now, unfortunately, for last week, we didn't quite get down to that 139, 140 area, so I did nothing, but that's trading for you. The important aspect here is that when there's higher volatility in play, you need to see a clear picture of where to trade. For the here and now, you can put the old 38.2 fib at 148.69 on your list as a potential resistance level if we continue to bounce. And then 152 again will be a huge level if we get up there. So throughout all this, you have places to look for shorts and trades and places to look for longs with plenty of pips in between, but you're staying out of the everyday noise. You can sit back, take it easy, and just try and trade those bigger levels if they seem.
Good stuff. I think you're absolutely spot on there, mate. Let's move on then to our plays of the day. Right, I'm going to be looking at the equity space this week, keeping things nice and simple. The Nasdaq bouncing nicely off its 200-day moving average last week, while the S&P 500 closed north of its 100-day moving average into the close on Friday. I think that should give the bulls some momentum into the new trading week. And of course, the fundamental bull case of strong earnings growth, strong economic growth, and the Fed put remain intact. If we get a decent retail sales number, that would certainly help things along into Jackson Hole next week, and then Nvidia earnings the week after. But if we get any dips down towards those 200-day moving averages, they are there to be bought in my view. Relatively short and sweet from me this week. That might be the quickest play of the day I've ever done, which gives you plenty of time, Ryan, to dig into the euro.
Well, unfortunately, I'm going to make mine a nice quick one as well because I'm just looking to play the range in this one. A nice simple trade for me this week. Euro dollar confirmed the 110 level as a top amid the 105, 110 range that you can see in the shaded area there. And as that held over extreme moves from last week, it gives me some faith that it could hold again for a potential short. So that's what I'm looking at. However, when we trade an asset, we always trade it on its merits at the time. So I'll be watching to see what exactly drives us back to that 110 area before stepping in. Also, I don't need to risk much on this trade as above 110.20. The trade is going to look wrong. So a tight stop just above there is where I'll be looking. If I get in, I'll be looking for a move back down to the low 109s, but I'll be slicing and dicing on the way should that happen. So that's mine for the week.
Good stuff. Short and sweet from both of us, and that does indeed bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to Kyriakos, our producer, for bringing this together as brilliantly as always. If you've enjoyed the show, please drop a like on the video, leave a comment as well. Let us know how you're trading the markets and your thoughts on anything that we've discussed in the show today. And we'll be back in a fortnight's time towards the tail end of August to review the last couple of weeks of price action and look ahead to what I think is going to be a very, very busy September for the financial markets as well. In the meantime, have a very good couple of weeks and we will see you then. Thanks as always for watching. Goodbye for now.